Thank you for that. And friends, thank you for those of you who've braved the early morning and are out here. We do hope that the day sees more of your colleagues joining, so please pull out your phones and start messaging people to show up. It's clearly not nice seeing a room so empty early in the morning, but I'm sure with what VCCircle have been doing over the years, the room will see more crowds during the day. So with that, just to get started with, some leg pulling on this panel of what we'd say old rascals within the industry. Most of us have been around, seen the industry evolve over the last couple of decades. Just like to get your starting comments on what have been the defining moments during that journey that you've seen within the industry. So Vishal, if we could start with you on that.
Sure. So thanks, Sanjay. That's a pretty broad question. So let me maybe just talk about a few defining moments and go back to, if you look over the 2 decades that Warburg Pincus has been investing in India and a little over 2 decades that the industry's been around since we started, I'd say it's been sort of 2 decades. The first decade was very much one of finding high quality entrepreneurs and companies where you could invest in. Most of those were public. So the form of the industry really took the form of pipes and investing in those and then watching the industry grow. And about a decade ago, I'd say a little more than that, India became more discovered. And you really had what I would call as this next wave of private equity of finding the next generation entrepreneur. The next set of professionals who wanted to build their companies and really invest in them as younger entities, private entities, and take it to the next level. So it's been terrific to see, defining moments, many successes early on. Obviously for us, it was the investment in Airtel, which I think in many cases, I'm happy to talk about it, but just to be clear, I wasn't around then, so I can't take any credit for it. But that doesn't stop me once in a while. It was really a defining moment both for Warburg Pincus and the industry here.
Manish?
First, great being here. And I would subscribe to many things that Vishal said. But let me take a slightly different crack at it. I think the underlying beauty of these last 2 decades, which we've all benefited from, learned from, made our fair share of mistakes also, of course, has been the superb quality of Indian entrepreneurs. Right? And whether these were large family-owned conglomerates, like in the case of Airtel, or these were startups which we were supporting, it's actually been more a testament to that quality. What I've seen is literally 2 sort of waves in India. One is up till 2007, where we actually all rode the beta, right? We all benefited from the early part of the decade 2000 to 2007, given the rising markets. I think it's the last 10 years which have really shown the true colors of private equity in terms of what do we need to do as GPs to actually earn our bread. It's not just, a couple of quick things, right? There's been a significant plethora of capital coming into the country. It's not just the sort of guys who are GPs in this room, there's sovereigns, the large pension funds, etc., all doing exactly what we're doing. So to really find your space, to differentiate yourself and make sure there's actually a reason for you to be in the room is what's really defined private equity in the last 10 years. And I'm sure we'll speak a lot more about that in the coming 41 minutes and 23 seconds.
Sanjay?
So I think some of the points have been covered. I would just add that, look, I think private equity as an industry, I feel, has really come in the last 2 decades, become more mainstream. It's no longer just a corner of, an alternative investment phrase or that catches it. I think it's very mainstream today. I mean, if you think about $10 to $15 billion and what that does to the private ecosystem, to the Indian entrepreneurs that Manish talked about, the wonderful quality of the entrepreneurs and the entrepreneurial talent you have in this country, I think private equity has really transformed the options available to Indian entrepreneurs. IPO markets, as you know, have been very volatile in India. There was a period in 95, 96 when there was hundreds of them. Then it was shut for a long period of time. 2010 to 15, I think there was IPO windows were shut. And so the availability of private equity capital, I feel, has defined the options for many businesses who've taken more risk. They've gone out for newer businesses, newer opportunities, newer segments, etc. That's one. I think also it has defined more opportunities for entrepreneurial talent, managerial talent. People, think about ESOPs were once limited only to the Infosys of the world or the IT services sector. I remember in Shriram Transport in maybe 2002, 2003, we sat down and devised the first ESOP scheme, if you will, in the NBFC sector, and we probably gave out 1 to 2%. But it was defining for the industry. And today, when you think about 15 startups that are happening in the financial services industry, almost all of them have between 5 to 10%. So it's very intriguing that, because of private equity capital, startup capital behind these industries, the range of opportunities for talent has also widened quite deeply. There were lots of questions, I think, back in 2013, 11, 12, 13 about private equity as an investment class. Has returns really been generated? What's really happened? I think we're, and some of us have really gone through these cycles. I can talk a little bit about ChrysCapital, at least. Now that we've gone through, we're on our 7th fund, right? And we've actually closed first funds 1 through 5. So if you've gone through 5 cycles, you can actually talk about data and talk about convincingly about how returns have actually been generated by the industry over a long period of time. And I'll talk more about it later. But I think the underlying theme for me today is that in 2 decades, private equity has really become mainstream and influencing real businesses in ways that were not possible in India prior to us having evolved as an industry.
Paddy?
Since you said on a lighter vein, so I would say to begin with, the sort of coming of age moment is the fact that you have people sitting around in this room and who are talking about a couple of decades of experience. And that, I think, defines the sophistication that has come in. I think as Vishal said, I would say that there was a period till about 2006 where there was lots of low-hanging fruit. You were swimming with the tide. It was relatively easy to make money. And then you had a period post that where the opposite was there. You were swimming against the tide and you had to really work hard to make money. And sometimes the macro was not supportive because growth had slowed down and multiples were compressing. I think now we are in a situation where it's about differentiating your platform, finding the right entrepreneurs to back. I agree. There's, as some of my co-panelists said, there's a good base of high-quality entrepreneurs who want to create sustainable value and where we as private equity investors can really help them in the journey alongside. And obviously coming in at disciplined valuations, which is important in the Indian market given valuations always tend to be rich. But I think the next few years or decade as a vintage should be good for those funds which have strong differentiation built into them. And continue to invest at a calibrated pace.
So very interesting points. And Manav, before you're reaching for your mic, I'm going to twist the question around because I want to probe a little into the points raised by the other panelists. But before I do that, you represent, I'd say, a different take on the industry with clearly one of the largest financial institutions from the country coming in. And while SBI has been involved in some manner in the alternative space, now with Neve, it is a foray into impact investing in a certain sense. Where did this entire thing germinate from, and how do you see that coexisting with what one would say is a largely undifferentiated industry segment where we would argue, and I would tend to profess, profit is the key motivator?
So I think it's a very interesting question, and I will not miss out my turn on speaking about the experience of private equity, what it has done. So to answer the first part of what you brought up is, when I first started investing, it was all froth. I was an infrastructure investor, and people were asking for $1 million valuation on they would sleep with the 10 megawatts, and next day morning it would be 12 megawatts. But from my perspective, what I have seen private equity do is to create industries where there were none. For example, I would assume that the entire renewable industry was created through private equity money. That time, even the banks were not ready to invest. The only investors that were available were private equity money. In some ways, you could say a lot of logistics which has come into being is actually private equity money. So what private equity money has done in India, in my opinion, is that it has created industries and businesses which otherwise would have found it very difficult to come in. Obviously, over a period of time, they mature and other forms of capital come into play. Your next question about what is SBI doing here and what is SBI going to do in this space. So SBI obviously is the largest financial institution in the country, but SBI has not been a player of any substance in private equity. It had a couple of joint ventures with Macquarie, which during that time I was on the other side of the joint venture at Macquarie, and with Oman Fund, but nothing of substance. SBI is now has a stated policy of getting into the entire private equity space in a deliberate manner, with SBI itself being a GP. So what you're seeing me today is representing the GP of SBI, and Neve the impact is only the first of the investment funds. We will continue to have multiple investment vehicles. On the differentiated space of impact, the way we look at SBI is to say that the impact is slightly overused word, and we had a small conference in the morning wherein we were talking about going beyond impact, looking at the entire space of ethical investing and turning the lens onto ourselves also as GPs to say, what are we doing to create an ecosystem wherein it is not impact versus profit question anymore. It is about aligning the entire ecosystem, right from our LPs to ourselves as GPs to our investee companies, as one seamless chain of investing ethically, because we do believe that if we were to invest ethically, it would actually give higher returns. So even if when we're not doing impact investments, for example, our next fund is going to be a stressed fund or an SME fund, it will continue to have that DNA of what we call as ethical investing.
Thanks for that, man. Now, next up, just to be a little provocative, one of the points that one hears, and this coming from someone who represents a regional fund, so maybe a bit of a bias, but one of the points that one hears often from LPs is India hasn't necessarily lived up to its promise, or the Indian private equity industry hasn't really lived up to its promise as people measure returns, as people measure distributions. The track record of India across most vintages, barring a few, has been a little on the lower side. 2017 appears to be a welcome change. Manish, you're on the back of a very successful fundraise, and one is also seeing a maturing of the industry with LPs driving towards quality. So congratulations on that, Manish. But as you look at the entire experience that people have had, just dive in, and this is a bit of a soul searching, dive into what have been your biggest successes and your biggest failures, and what have you learned from this market? What works in this market and what doesn't work?
Wow, Sanjay, that's way too early in the morning for that sort of soul searching. But let me attempt a response, Sanjay. Firstly, I would completely agree that if you look at this from a lens of an LP over the 2 decades that we've talked about, I think as an industry, as a set of GPs, we have definitely disappointed, and our returns have been abysmal, right? Now, you can try to explain a part of that away with the significant volatility we've had in the rupee-dollar exchange. So even in situations in the latter part of last decade when people made a significant amount of rupee returns, if you saw what happened to the dollar between 2007 and 2012, the majority of it was really lost away in terms of the rupee depreciating to the US dollar. And we'll get back to then, what it means for rupee investors, etc. But if I was to look at, if you keep that part aside, even despite that, I actually think one of our largest failures as an industry has not been so much to find good companies. I think we've done a good job in that. It's being able to figure out a way to return capital to our LPs over the 2 decades, right? And if I go through, both Patty and I were fortunate we were investing out of a sovereign fund in the last decade. But I think many of the excesses we saw in the middle part of the decade, running up to the 2007-8, there was a plethora of capital. All of us were competing for deal flow as an industry. And frankly, I think in the rush to deploy capital, in the rush to earn returns. As an industry, our returns fell, and we finally took on situations where there was too much capital, we had minority situations, we barely engaged with the portfolio companies. Again, broadly, these were the pipe type situations, and we saw it all fall flat on our faces when the big collapse came. And, you know, true to that old saying, a rising tide raises all boats, but it's literally the one when it's a receding tide, when you see who's really left swimming. But I think if I then go back and say the post-2007, what's really happened is a significant consolidation in the sector. And if I look at then, I would say one of the biggest challenges or the biggest failures was my inability to see in 2004 and 5 on which way the market would come. And hence in those situations, literally being in a few awkward situations. But then the real turnaround is when we set up Kedaara, and I feel most proud about that, and thanks for the comment on the fundraise, but it's only a reflection of what we've managed to do in the last 4 or 5 years. It's been a consistent focus on making sure you're coming in. I mean, this is basic stuff. We're not overpaying. We're coming in at the right valuations. It helps that the industry is consolidated, right? And there isn't that many pools of capital, so that's changing again. But then the two most significant things has been really our ability, and this is what I'm most proud of, to focus, which we didn't do in the last, and again, I'm saying we as an industry, I'm sure there were exceptions everywhere, to really get involved in the portfolio companies. 6 of our 9 companies in our portfolio control deals. We wouldn't have thought about that in the early part of the last decade. And then, secondly, and I'll try to end this now, is a paranoia focus on exits. I mean, from the day we get into a company, we're focused on saying, hey, how are we going to get out? That doesn't mean we're not long-term players, but we're very clear that in addition to having a very good company in a very good sector with very good management teams, we would not do a deal until it's clear to us on what our exit would be, right? So for us, the real successes and what I feel most proud about is not only the deals that we've done, but the ability to create an institution which hopefully will test and remain far beyond each of us go away. So I think the switch in India from being a non-active participant as an investor to being a very active participant and really driving exit, returning money to our LPs, showing a high DPI is what's really allowed us to successfully raise fund. And again, we're early birds in this whole thing. My friends like Sanjay have been around much longer in terms of Fund 7, so we still have a lot to learn from them.
So Sanjay, on that note, Fund 7, is the experience any different or?
No, so I have a point of view here, right? I think, in the last few years, we've been hearing this comment repeatedly, and I think there are exceptions and I wouldn't talk about exceptions, it's more as an industry we're maturing and the returns are actually pretty good. And so I would actually, while overall, I agree with what Manish just said in terms of the experience of LPs being not that great, but it's also a function of when the LPs got in. So if you look at the 20-year window, really it's, after the Bharti deal that he talked about, the Airtel exit, which then led to a big boom in the industry and big capital really got raised in 2006, 7, 8 and thereabouts. And the last 10 years have been a tough period. Global recession, macro headwinds around, currency and all of that. So those returns have been relatively low. And that was also true till maybe 2000. So there was a period from 2007 to 2000, maybe 12 or 13, where returns really did not go sideways. That has begun to change clearly now as returns have improved dramatically over the last 2 or 3 years. But if you look over a 2-decade period, Indian companies, Indian entrepreneurs, Indian businesses have really scaled. I mean, the number of companies, you can pick a sector, have gone 10x's and demonstrated that. I mean, think about pharma healthcare, right? We've been in companies like Intas. I remember when we first came in, their profit was 40 crore. And when we made a further investment, it's 1,200 crore. So these are, amazing companies, amazing entrepreneurs that we have the luxury of backing in India that generally generate returns. Now, you can point out and say, this is anecdotal, this is here. But, last month, we basically announced our 65th exit out of India, right? And that was a $500 million exit. It's a strategic deal we sold to Capgemini, a company called Liquid Hub. The broader point there is just the fact that, you have now GPs out of India who have delivered over $5 billion of exits back to LPs. You no longer can question whether this is a proper industry, whether it's a mainstream, whether returns have been generated. We've had 2 decades of $30+ IRRs that we've delivered today. So as an example of that, I feel that this question as an industry, we should really be able to stand up and address to LPs with confidence that we really can deliver returns out of India.
Perry, given that as managing partner, I'm sure you're in front of LPs fairly often. Do LPs buy that logic?
So I think I'll go with Sanjay's point of view that it depends on the period where which LPs had maximum exposure to India. And a lot of LPs who put in a lot of money in that 2007 to 10 period tend to be more skeptical. But just going back to returns for a sec, we had McKinsey present at one of IVCA's meets, and you'll be surprised to hear the numbers. So they covered the returns for global funds, Asia Pac, I think it was emerging market or Asia Pac, and then India funds. And all three since 2000, I think the period was all funds since 2004 or something like that, and exited since, were in the 13 to 14% net dollar return range. And, there's been a great deal of volatility in India and a period where returns have been very poor. As a consequence, LPs have become extremely conscious of exits, to Manisha's point. Not necessarily the best thing, to my mind. I think private equity ideally should be investing for 4 to 5 years, and partnering with entrepreneurs to really grow the businesses. That's the ideal period of time. But the ground reality is that LPs are quite focused on exits because of some experience in the past. But the last 2-3 years have seen plentiful exits, and I think that'll continue to be the case in the couple of years to come. So I see the story changing on India. And in a way, it's good it changes in a calibrated way because we don't want the situation where there's too much capital coming into India again. I think the biggest issue in 2007 was that India probably raised as much capital for India, which China did on an economy 3 times the size that time. So that obviously creates a demand-supply overhang. I think the parameters are more in check, and the industry is more mature. People are seasoned. So I would say the LP sentiment is slowly changing. However, they are a bit focused on exits from India.
Vishal, as someone who I'm sure is fighting internally for allocations into India relative to other Asian markets, how do you rank on a relative basis the opportunity set in India versus, let's say, China or some of the Southeast Asian markets? And as you dive into your IC deliberations, is the entire volatility of India a big subject matter? Is the entire exit question mark from India a big subject matter in those discussions?
Yeah, look, so a couple of things I should point out. One is I agree with everything that's been said, so I'll just step back a second and take a different twist on it. India, for Warburg Pincus, has been a net contributor to our global returns, and this is over the last 2 decades. I still agree with what Manish said. As an industry, I come at it a little bit differently. I think the industry here is still nascent. I mean, what are we talking about, right? Of course, it's grown to a fantastic level, but it's still early innings. And I'd say particularly the last 5 or 10 years has been early in India. Now, we, touch wood, as Warburg Pincus, have done well in India. To your point, I think it's less of today when I sit there, it's less of a fight for allocation. It just doesn't happen. In fact, it's the opposite. I think folks are saying, why aren't we investing more in India? And I'm sitting here and saying, wait a second, it's not that easy. It's not easy to invest in India. It looks great from a macro perspective. And I think, though, with the industry maturing, the points that are raised within funds that have experience, behind GPs and managers that have been there and proved their track record, I think investors are really looking for those types of funds to invest in. Again, my sense, we raise out of a global fund. I don't sit out there. I have the luxury of not having to go out and fundraise for India in particular. But I think India today, from an investor point of view, the alternative space, the private equity space, the VC space is about as exciting as anything we see around the world. So that's, I hope I answered a question, but that's basically how we feel.
So Manav, as someone who's had a fair bit of exposure into infrastructure sectors, and you spoke about renewable really being the creation of the private equity industry, do you see where India is poised today? And clearly everyone talks about the big infra opportunity, but do you see global LPs biting into that opportunity based on past track record?
See, I think infrastructure as an asset class for global LPs will be challenging. It's been challenging for the last 10 years, and and for the right reasons. It is a fairly regulated sector, and regulated sector means an interface with the government, and that comes with a set of challenges. So, not all international LPs would be keen or comfortable. But a larger question is that should infrastructure, I mean, Canadians apart, I mean, the recent evidence of Canadian pension funds investing in India kind of belies what I'm trying to say. But a larger question is that, especially for infrastructure as an asset class, the only money which is most apt is actually domestic money. So in some ways, your question should be, and perhaps some of the panelists could answer that better, is why should Indian domestic money not be flowing into infrastructure as an asset class, because it's a rupee exposure, it's a rupee return, and what prevents that coming into infrastructure asset class and a larger private equity in play as well?
Actually, I had that question below in the list, so let me take that on right now, and this is more aimed at Mani, Sanjay, and Patty, I guess not so relevant for you or me, Vishal, which is about domestic capital. Traditionally, most of us within the industry, we've relied on foreign capital, though of course a few people have successfully managed to target domestic pools of capital, and one hears increasing traction within that space. Two questions really. Do you believe that for private equity, domestic capital still continues to be relevant? So there used to be a regulatory arbitrage in a number of sectors like retail, like financial services, telecoms historically. With liberalization on that, is domestic capital still relevant and required for the industry? And are you really seeing a maturing in the sources of capital and enough traction out there for you to set up separate vehicles to raise that pool of capital? So Patty, maybe if you want to start first on this one.
Sure, that's an area where, through my role at IVCA, we've been quite active, and I must say the government has been extremely supportive of reforms for the alternative investment fund sector in India. So there've been a spate of reforms and initiatives on that front, and some of my colleagues at IVCA have really worked tirelessly on that. So take an example, there's no IPO lockup for AIFs. Clarity on characterization of tax, opening up some of the domestic pools of capital for investments into AIFs. So I think there is a lot of push in that direction. It goes as part of the sort of Make in India initiative to have fund management onshore. There are still sort of frictional issues which remain to be resolved. For example, the friction cost of GST when you are catering largely to offshore investors. Currently, if as a fund manager, you are exporting the service, you're not subject to GST, but the moment you bring the fund onshore, there is a very high incidence of 18%, which is a high friction cost. So there are issues like that to be sorted out, but I think the government also clearly recognizes the role of AIFs in private equity in the growth of companies and entrepreneurs in India. I think there have been enough studies done to show private equity invested companies, portfolio companies have done better on job creation, have grown faster on revenues and earnings, better on reform, on innovation, and have paid more taxes, most importantly for the government. Almost 2x the taxes. A couple of studies, again done by partners like McKinsey and Bain, have shown that. So I think there's going to be a push towards more funds being managed domestically, even if the pools of capital are from overseas. And at the same time, it's important to encourage some domestic LP base. And there is another area where IVCA plays a role in educating the domestic LPs and bringing best practices to them. The quantum of money coming from domestic LPs may not be significant, but it's important that we cater to that segment and make that grow over a period of time to build a sustainable private equity industry in India.
Manish, have you raised any rupee capital, and what are your overall thoughts on the topic?
Well, without going into the specifics in our particular situation, I just want to take this discussion a bit further than just the AIF structure and focus a bit, Sanjay, to the sources of the eventual sources of capital, where, to your point, historically we've looked at global pools of capital, be it endowments and pension funds and sovereigns, to a very interesting situation where I think the Indian market is about ready to start deploying this capital. And I really believe fundamentally, today if you look at it, there are actually very sophisticated family offices already which are already deploying money in this asset class. But I think the much larger opportunity exists actually with insurance firms. If you look at globally, the duration matching effect of long-term capital, especially in life insurance, with the sort of investments we do, which are actually long-dated, there's actually a superb natural hedging and matching, which is great for this asset class and giving patient capital long-term returns, and eventually, frankly, the pension fund industry. And I think the two big issues in this one of the biggest issues we've had, especially in the 07 to 012 period, was the volatility in returns. And no matter in our AIF structures or the GPs, when we raise capital, historically it's always been dollar capital. So no matter how well your investment does in rupee terms, when the rupee depreciates, which is tended to do, our returns are affected. The biggest positive on raising domestic capital is actually there is absolute transparency of performance, and what you return, what you perform is what you return to your LPs. So I think going forward, and I think the Chinese, if you look at the Chinese community in private equity, the level of renminbi funds which have been raised or joint US dollar renminbi funds is truly astonishing. And I think as regulations evolve in India, it's not just the family offices which I think have moved ahead of the curve, but also where it's needed more, which is the insurance firms and pension plans, which will actually get active. So it'll be a huge source of capital, and I think not only good for the GP and the private equity industry, but actually very good for the beneficiaries of those life insurance products in the long run, as well as the pension plans. It's really good for the country as a whole.
Sanjay, have you guys thought about domestic pools of capital?
No, sir, absolutely. I think if you look, the way forward is pretty clear. If you look at China, for example, the example that Manish just talked about, moved from 100% foreign capital to renminbi funds actually becoming more and more significant, even larger than foreign pools of capital. So it's a matter of time, to what Vishal said, we're very early in our state of evolution. Domestic pools of capital are going to become very, very significant going forward. We're already beginning to see that in our exits. When we talked a little bit about that, but 10 years ago, almost all our exits were driven by global pools of capital. We were selling into the Fidelities, the capitals of the world. When the companies went public, we were selling to global capital. Today, once our companies go public, our largest, people who are giving us exit are the ICICI and the HDFC Mutual Fund, and so institutional capital is beginning to come up in that side. But we are very, very early. I mean, today, institutional capital is not there. Pension funds in India are just about discovering equity to begin with as an asset class. So private equity and alternates is a step removed. But it will get there. It will get there like it did in China. Family offices are becoming larger. I think there is a learning curve there as well. I think people need to understand that private equity is a 10 plus 2-year product life cycle. And so there will be cycles and you will make return over a longish period of time. So there is an education, there's a curve that's going to be, that as an industry we'll live through. And eventually, 10 years from today, domestic pools of capital will be significant into private equity funds as well. But it's a slow curve. And today it's on the fringes from our point of view.
Manav,
today it's 0% for us as ChrysCapital. We have almost all foreign. But over time, this will
Manav,
play
given your sponsorship by SBI, I'm sure you have a direct line of sight into the powers that be and their thought process. So do you see greater traction being driven top-down into the insurance companies, the pension monies flowing into alternatives as an asset class? Or do you think there's still political resonance to this entire thing?
See, what I perceive is two trends which are happening simultaneously. There are these bunch of domestic capital, be it State Bank or other public sector banks, the insurance companies, the NABARs and the SIDBs of the world. When you engage them, there is an extremely high keenness to be invested in private equity as an asset class. So it is in some ways incumbent upon GPs such as ourselves and the company who's sitting here to actually access that capital and put it to play. The counter trend is this fear of unknown. Sanjay mentioned that they're just about discovering listed equity and private equity is far out. So there is this fear of unknown. I think it is, the trend is secular. There will be more domestic money. The key is for us as GPs to be able to educate and access that and speed up that process. The very fact that we exist, the very fact that I exist within the SBI system is clearly a demonstration that there is a realization within the banking system that they need to be present in this asset class and be present in a meaningful manner. And therefore, once again, just to repeat myself, it really is now incumbent upon the asset managers to go and access that capital and allay whatever fear that those guys have.
Vishal, a flip of this entire thing is, now Sanjay spoke about exiting to the HDFC mutual fund, the Reliance mutual fund, etc. And I guess over the last year and a half or post November 2016, we've been seeing a lot of money flowing into mutual funds as well. And public markets clearly are being supported with that institutional money. But the entire perception that India is an expensive market, that multiples in India are twice those of the multiples in a China, a non-Indonesia, Southeast Asia context, is one big issue that people have seen deploying capital in India. And that, when you marry with the non-availability of leverage to private equity investors, at least onshore, or the difficulty of doing that. So that's one bucket set. On the other hand, you have promoters for whom traditionally, and barring the events of the last 10 days with what's happening in the banking side, promoters have been able to raise leverage from banking circles, or they've been able to target the capital markets fairly early on in their life cycle. So they've had alternatives to private equity. So as you've thought through this, dual dynamic flow of expensive valuations, low leverage, so you really need to look at other sources of value creation out there, and you have promoters who've got alternatives. How have you looked at crafting your own investment strategy, be it in identifying assets or post-investment value add, or even thinking about alternative routes to exit to boost the eventual multiples? How have you approached this entire piece?
So lots of questions in that, but let me just take the first one because I think it's interesting. I think you hear a lot that India is expensive. Valuations are high. I had someone who told me India goes through cycles. It's either expensive or it's very expensive. And for quality in India, there hasn't been a time as a private equity investor or a VC investor, they can say, okay, let me go buy something of quality really cheap and invest in it cheap. I don't think that's what we've ever done. And I think we've tried to do it actually in the past. It's been some of our mistakes, to be honest. And what I think the opportunity is on those two fronts is twofold. One, I think you have, if you look around the world, coming back to your question, you've got a stable government out here. You've got reforms that have taken place, starting with demonetization that you talked to, formalization of savings. You've got some massive waves going from informal to the formal economy, things India has struggled with for a long time. On the flip side, you've got the promoter dynamic, where India has always been very much a promoter-driven economy. And I think that is changing to where preferential access to capital, whether it's the banking system and the markets, is changing. I'm not saying it's changed, but it's changing. And so for us as private equity, if you ask me what excites me the most, and coming back to what was mentioned earlier, is the entrepreneurs. You got an entire class of entrepreneurs, professional managers, high integrity people that are saying, okay, let me go out and set up a business or go out and build something on my own. And now those are the folks who you can say, okay, private equity can really help. Both supporting them with value add in terms of helping them build their business, but also providing that initial slug of capital. I'll be very honest. I mean, we did it with Airtel. I talked about it many, many years ago. But to be honest, Airtel, or maybe Airtel's a bad example, but a whole bunch of big companies, they don't need our private equity capital. They haven't needed it. They got access to lower cost capital. They're well-established entrepreneurs. So it's that other part of it, which is the new generation entrepreneur, that gets me excited. So yes, there may be no leverage. Yes, valuations are expensive or very expensive. But there's a wave out here in India. And if you get the right wave, and if you've got the right team, I think with a 5-10-year horizon, we found it works pretty well. So that's what we're looking for.
Manish, as I call upon you to, also look at answering that question, I'd layer on one more point, and that takes from something that you stated earlier, that you're seeing the bulk of your portfolio today is controlled deals. Is controlled deals the result of proactive investment strategy from your side? Or is it that the market is fundamentally changing and you have greater supply coming through?
A great question, Sanjay. I think it's being driven by two different sort of themes. One, to what Vishal was saying earlier, or alluding to at least, is you see the larger conglomerates actually for the first time, well, as of 5 or 10 years ago, willing to divest businesses where they don't see as core to the center, which wasn't done about 10 years ago. I think that's well established, right? So there's a whole bunch of larger diversified conglomerates, Tata's being a classic example, pillars, who not only have you already seen, but increasingly you'll see them not wanting to partner with, but actually to get out of certain sectors. And I think their private equity, in addition to a few strategics, has a huge role to play. The other is actually the point around helping the first and second generation entrepreneurs or professionals who are setting up a platform deal. So in both these cases, you see the entrepreneurs setting up a company from scratch, essentially what we call a platform deal, where you're helping not invest in a positive EBITDA company, but help build up a company which will grow over the next 10 years. We did that with AU Housing. It was a subsidiary of ours, of AU, which all three of us had invested in as ChrysCapital, as Warburg Pincus, and us as Kedaara. We took a subsidiary, which was the housing finance company, supported the existing management team, which got to Sanjay's earlier point, a significant amount of ESOPs, but the controlling shareholder by far was us. That's one. The second is actually first and second generation entrepreneurs who actually have built great companies, but are actually seeing a reason for a variety of reasons. Maybe the kids aren't active, they don't want to be involved. Very willing to give seed a significant amount of governance to a player who they think they will add value alongside them. So in those, it's sort of joint control, and they're eventually looking to exit those businesses over a longer period of time. So again, I see a changing trend where three sources of deal flow: large corporates divesting companies, which is very clear; platform situations where we can partner with a young entrepreneur, which was, we did in AU, in Avas Housing; and thirdly, first and second generation entrepreneurs who are looking for an eventual exit, but really want to bootstrap or really kick the performance for 4 or 5 years with the help of a value-added player, and then sell the company together. So I think it's a changing trend. I see this as a trend which is going to be here to stay, and a lot of us will be actively participating in that.
Patty, any concluding remarks from your side?
For us, the bulk of our portfolio is still growth minority deals. But even in those deals, I think we believe we played a significant role in helping these companies with the next phase of growth and institutionalizing them, professionalizing them. So we have an average EBITDA growth rate across the portfolio compounded since inception of more than 20%. And that's what mitigates the risk of valuations, because if your underlying portfolio is growing at that clip, it's quite likely you'll make those returns or better. The only other point I'd like to comment on, again, on entry valuations, I second Vishal's point that you have to back high-quality businesses and entrepreneurs and don't, for the sake of valuations, don't go for suboptimal management teams. But I think what's worked well for us is also getting into sectors a little ahead of the curve. So, for example, we backed an auto component business just before the elections when that sector was completely out of favor. And, that company is going to an IPO. We made an investment in the media space before digitization. In the EPC space when, it had gone out of favor with private equity. So if you think that, so what's worked for us in our playbook is if you're backing high quality businesses, even in industries which are perhaps out of favor at that point of time, I think you're generally likely to make good on it if you have a 4-5 year investment horizon.
Well, I think with that, it's a wrap because I see a lot of zeros on the screen in front of me. So I'd like to take the opportunity to thank everyone on the panel. I hope you guys enjoyed it. Thank you.